don't know the future. I didn't come here to tell you how this is going to end. I came here to tell you how it's going to begin. I'm going to hang up this phone, and then I'm going to show these people what you don't want them to see.
I found a flaw in the model that I perceived is the critical functioning structure that defines how the world works, so to speak.
In other words, you found that your ideology was not right. It was not working.
Precisely.
Like, my bank is the worst. They are screwing me, my bank. You know what they did to me? They're charging me money for not having enough money.
I think you gave us the responsibility in the Federal Reserve Act to oversee the stability of the financial system through our lending facilities, to be the lender of last resort, and we are trying to execute that to the best of our ability.
There are really only two things anyone needs to know about the monetary system. One, all money is created out of debt. Money is monetized debt, whether it materialized from treasury bonds, home loan contracts, or credit cards. In other words, if all outstanding debt was to be repaid right now, there would not be $1 in circulation. And two, interest is charged on virtually all loans made, and the money needed to pay back this interest does not exist in the money supply outright. So, if all this debt was to be repaid right now, not only would there not be $1 left in circulation, there would also be a gigantic amount of money owed that is literally impossible to pay back, for it does not exist.
And now all of a sudden, not you, but all of us who are Americans are going to have to pay an extra $5 trillion in one weekend for private people who committed fraud. This is outrageous. Who are these people who are taking our money and doing this and ruining America?
I would personally be very, very reluctant to release the individual names of the ball.
What do you think might happen if people knew how their $1.2 trillion had been spent? Do you think they might be angry?
No, I don't know, obviously. I think that they can judge how the money is spent from how the money is lent from what we're telling them.
This is what it boils down to. She says, well, you only have $20. That's not enough. You can't just have $20. So we're going to charge you $15. So they charged me $15. Then I had $5. Now, I don't know if you've ever had only $5 in the bank. But guess what? You can't get it out. You can't.
If I have $1 million to spare and I put it into a CD at 4% interest, I will make $40,000 a year. No social contribution, no nothing. However, if I'm a lower class person and have to take loans to buy my car or home, I am paying in interest, which, in abstraction, is going to pay that millionaire with the 4% CD. This stealing from the poor to pay the rich is a foundational, built-in aspect of the monetary system.
What kind of a system is that? They have people at the bank, they go, okay, some of these people don't have enough money, so we better take their money away from them because they have so little. That's it. There's no better explanation than that. Then they go, these people have so much. If you have a lot of money, they give you money just for having it. They go, you have so much money. We should give you more because you have so much. Here, take this guy's 15. The hell with him. What the hell is he doing with it? Just wasting our time.
It's a bad joke.
And while we have seen the bailouts of corporations and banks by governments, which of course comedically borrow their money from banks to begin with, we are now seeing attempts to bail out whole countries by conglomerates of other countries through the international banks. But how do you bail out a planet? There is no country out there that isn't now saturated in debt. The cascade of sovereign debt defaults we have seen can only be the beginning when the math is taken into account. It has been estimated in the United States alone that income tax would need to be raised to 65% per person just to cover the interest in the near future.
What does that mean? That means I don't even have no money anymore. I wish I had nothing, but I don't have it. I don't have that much.
Hold on, let me get this straight. The world is going bankrupt, whatever the hell that means, because of this idea called debt, which doesn't even exist in the physical reality. It's only part of a game that we've invented. And yet the well-being of billions of people is now being compromised. Extreme layoffs, tent cities, accelerating poverty, austerity measures imposed, schools shutting down, child hunger, and other levels of familial deprivation, all because of this elaborate fiction. What are we, fucking stupid?
Work, there's an infinity of things you can do. You can make every city, every garden, every house a paradise. There's an infinity amount of things to be done to reach there. Don't expect to be paid for it in national money. Don't get that idea. So we have to find another way.
I'm going to show them a world without you. A world where anything is possible. Where we go from there is a choice I leave to you.
In a mutual credit system, everyone has an account. This account can go positive and it can go negative. When Bob repairs Andrew's hotel, Bob receives a credit and Andrew receives a debit. Bob can then use that credit to buy catering from Christine. Andrew works off his debit by providing lodging for Daniel. When Daniel does dental work for Christine, the credit and debit are cleared. No hard cash was needed, and everyone gained something in the transaction.
Over the long run, we expect that each person is going to put in as much as they take out and take out as much as they put in. But we allow these temporary imbalances in order to facilitate this exchange process. This is the fundamental function of money.
As more people join the mutual credit clearing circle, this process can become more dynamic. Ultimately, no matter how big the circle gets, the value people contribute should remain equal to the value they take out.
This is money created not by a hierarchy, but it's a medium of exchange that's created between us. Second, there's no interest. Third, it's not scarce.
When you start trading in forthcoming exchange, many people talk about experiencing shift in consciousness. There's not a scarcity of that currency, so there's much less competition. So you end up with a completely different experience, and people talk about how cooperative, supportive, people are really concerned about your well-being.
So the primary distinction between money that is tight, scarce, limited, comes from them, and money that is free, available, sufficient, and comes from us, is that with one, we are in fear and greed and competition, and with the other, we behave like sensible human beings. We are more generous, we're more comfortable, we're more giving, we're more willing to receive.
We don't need to have all this suffering around money. We can free ourselves from it. And the economy can be much healthier and much more of service to all of us.
Time to become aware, time to have a consciousness of our potential. And I think our potential as humans is infinite. Let's not limit ourselves through the medium of exchange. Time to wake up.
Good morning. I think my sound should be on. Let me just check that. Audio 1 2 3 1 2 3. Right, I think we're wired for sound. Just one more thing. Let's just.
In the United States alone, that income tax would be.
Right. Yeah, we're wired for sound. Just one more. There we are. Just check that. That's coming out. Anyway, that was a video called Fixing Money on the Sustainable Human blog from published first on June the 25th, 2012. So that was in the fallout austerity and the sovereign debt crisis, post-financial crisis, banking crisis bailouts, the whole 9 yards. Bernard Lietaer made an appearance in that. Bernard Lietaer died actually a few years ago, sadly, and his work isn't widely enough discussed and available around the internet. On my blog, there's quite a few references to it, and Bernard wrote many books. So if you do search, it's Bernard Lietaer, Bernard Lietaer. Now, I started making a video yesterday, and that video was about the current rising interest rates, which the Bank of England says, and the Villa and Market commentators say is to fight inflation. Now, there are many economists, not that you hear from them that much, that will absolutely say that this is not how one deals with inflation. Inflation is a monetary phenomena, and the reason that there's inflation in the economy at the moment is because the monetary base was expanded so much during the pandemic. Very few people mention that. I listened to the BBC yesterday on the PM program, and there were a couple of talking heads talking to the guy who does what's it called now? That Dragon's Den. He's an economics correspondent on the anyway, he's kind of the go-to BBC public intellectual, but I mean, quite honestly, Iain something he's called, his take on things, the limit of the window of his reference, his blind panic when someone sort of mentions something that's slightly outside of his Janet and John Mickey Mouse narrative, it is very clear, and a critical view of where we're at in the United Kingdom economy generally. So this is small businesses, small to medium-sized enterprises, the availability of working capital for those small businesses, that's dried up. Now, that's a monetary phenomenon as well. And I'm going to get a document that I started working on yesterday up on the screen, and just go through some of the, here it is here. So if I just bring this over here and then I remove that, and then I say present, share screen. Bear with me, and we're going to share entire screen. We want to share that one. Share. Okie dokie. Right then. So here's this document. I'm just going to make this large, and I'm just going to take it from the top. So here we go. This is from a article from 2012, which appeared in the Real World Economics Review. And I'm just going to read the relevant parts. I'll put the link in the description that appears in this document. So the operational truth of today's financial systems is that only commercial banks create money when they grant loans, as in loans make deposits, and they can do so without the slightest size limitation, because even in the case of required reserve ratio restraints, the central bank to which it is dependent will have to provide it as much as these same reserves as it needs, because otherwise it would totally lose control of its benchmark interest rates. The ECB, so that's the European Central Bank's insistence that it can navigate M3 money supply via adjustments in benchmark interest rates, is in reality a subterfuge to avoid admitting that its interest rate moves have no impact on the cost of money. Since this is one of the major variables in determining investment projects and consumption via the credit cost channel, its real aim is to modulate the growth rate of the real economy. We can even say that when it hardens monetary policy, it is trying to increase the unemployment rate of the active population, declining payroll costs, one of the key variables of its neoclassic bias, as illustrated by the famous ISLM curve. So, this was a graph that appeared with that article, and it shows deposits in the Eurozone banking system from 1999 to 2011. So the period immediately before this article appeared, and you can see that there was a doubling, or over a doubling, of deposits in the Eurozone banking system, which means there was a doubling of the amount of money that commercial banks made in loans to individuals, businesses, governments. So that's was running at I think that's 10 trillion there. So it's about 10.3 trillion in 2000, midway through 2011. Now, these were some graphs that I got yesterday. Bank balance sheet deposits, okay, again in the euro area, for households, corporates, and the insurance and pension funds. So you can see that households are at about, call that 9 trillion. Corporates are at about 3.75 trillion. So let's call that, what's that then? 7.5 trillion. No, that's what we're saying. That's about 9, about 3.5. That's 12.5. And insurance and pension funds, their deposits have gone down from 700 billion to about 400 billion. So that's about 14. That's about 14 trillion. That doesn't actually sound enough, actually. So there must be something else missing there. If I just open here, this is the Trading Economics website, and just some bond information. It's a countries, euro area, right? Just to make this point, and right, money. What is bank? Central bank deposit balance sheet. Bank balance sheets have disappeared from there. That's very strange. I just... Right, so in the UK, you have money, banks balance sheets. Euro area. Okay, it's only got the central bank balance sheet. So we say over 25 years. what's this here then? So central bank balance sheet is $7,712,715,000,000. Right, so that's 7 trillion. Let's just get that back up. I'm sorry to be thinking out loud here. And we're gonna just go copy the hyperlink there. Let's just go here. Paste. Right, so here's this article that I was referring to, money circulation in the Eurozone, banks, deposits under the lens. Okay, it's well worth a read. And it's by a guy called Erwan Mahe, or Mare. So here we're taking a look at money supply of slightly over 10 trillion, okay, which compares to 5 trillions in 2000. So money supply doubled from 2000 to 2010, from 5 trillion to 10 trillion. And that's euros. Let's just go back here. Euro area central bank balance sheet is at 8 trillion. That's a central bank. Now, let's just take Germany. Money. Right. So in that paper, Germany was such a big part of the European economy that they took that out of some of the analysis because it skewed the samples. But let's have a look here. So bank balance sheet. Okay, so that is 10 trillion. So Germany alone is 10 trillion now. So let's just have a look at France. France money bank balance sheet. 25 years. Okay, bank balance sheet is, all right, now we've got to count the noughts here. 3, 6. Hold on, we've got to put 3 noughts on the end of that. No, 6 noughts on the end of there, which means you end up with 12 noughts, which is 11 trillion. That's interesting. French banks. So that's 22 trillion just in Germany and France. Is that right? Hold on, let's just go. Germany. Yeah. 10 trillion, 11 trillion, so 22 trillion. So Germany and France alone have doubled deposits. Balance sheet is basically the net deposits over liability. So anyway, deposits have hugely inflated. Now, I'm not sure if it'll be open here. Right. Event 201 with hindsight. So event 201 is the what I call the pandemic. Johns Hopkins University did a war gaming or pandemic gaming exercise in the November of 2019 before it started. And if you watch it, there's all sorts of stuff. There was another one done a year or two before called Cladex. And again, basically everything that happened in the next 3 years is condensed down into, you know, everything that they said would happen in 2019. I'm slightly confused as to why people say that we weren't prepared. There were all these people, there they were preparing for it. So go figure. Right, event 201, with hindsight, was it a monetary event? So here we are. Let's have a look. I should have some bank balance sheet stuff here. This is just showing GDP going up with all the money that was put into the system. Here we are, event 201. Oh boy, right, where are we? Let's have a look. Anyway, I digress. The point being that interest is the price of money, and bankers prefer money to be in short supply so they can charge a higher price for it. And what all of the last 6 months we've seen a contraction in money supply, and with a contraction in money supply, that leads to something called demand destruction. And therefore, when you destroy demand in an economy, it makes the existing debt more valuable. And of course, with variable interest rates, you get a higher return on your money, etc. Now, if you're a businessman, you think, well, hold on a second, that's the bank, they're kind of sabotaging my business. This is what Mahe says here. The point that the point of the policy is to increase the rate of unemployment, which basically means people lose their jobs, which means businesses aren't doing as well. Now, who benefits from that? Well, the answer to that is the benefit is to the banking system and to its debt. So as you saw in that first video, if everything's paid off, interest is still owing because the money isn't created to do that. So this article here talks about the famous equation, money velocity equals price and quantity. So that is it's an accounting identity, really, as much as anything. And velocity of money is affected by confidence. And so if the supply of money starts falling, people start hanging on to it because there's less of it. Banks are putting the price of it up. So they're getting a higher return on the liabilities of their customers. And so they are actually benefiting from higher interest rates. Now, that's really a fundamental conflict of interest when we're told that interest rates are the main way of controlling inflation. Now, the other thing then about banks is that deflation is bad for business because it means prices are going down. So you can't hold stock because that means your inventory becomes less valuable. Well, from a banker's point of view, with deflation, the value of their money remains the same. If you've got a fixed or variable rate and you're putting your rates up, you get more of the stuff that you're holding as collateral against that debt. So a raising of interest rates environment can lead to forced sales And the very same people that create the money can then create money for themselves to buy those distressed assets. Now, those distressed assets don't necessarily have to be repossessed properties. They can be. That's what happened a lot in 2008, and it happened a lot in the early 90s. But the fact is that an increase in interest rate forces out weak hands, and hands have been weakened by the cost of greed crisis, which we've been told is a cost of living crisis, but that's actually corporate price gouging. So we've had the oil companies price gouging with the energy crisis, etc. The fundamentals of relative values of things, okay, haven't actually changed. It's the creditworthiness or perceived of different people arbitrarily decided by banks. Now, for some time, I've been saying that this time around, the people who have been teed up for looting are actually small buy-to-let landlords, right? And there is a narrative being quite widely demonizing landlords, demonizing buy-to-let landlords, right? Now, why would they do that in a market where there aren't enough properties to let alone enough affordable properties to let? Well, if you force the hand of the buy-to-let landlords by making their hand weaker, who stood on the sidelines to pick up the pieces but Lloyds Bank? They've got a property company now. In fact, they're more a property company than a bank these days. But also BlackRock, going direct, famous BlackRock. So that's what's actually happening here. So when at a superficial level, people look at the property market and say, oh, people are overpriced in their house, people's affordability, what can they afford to buy? Thinking beyond that, okay, who are the large players in the game here? And the large players in the game here are the government and the banks. And they're a good cop, bad cop relationship, right? So if you read Dr. Adrian Wrigley's paper, which is in the House of Commons library, dating back to about 2010, he sets out how the banking system works. And basically, the banks are given license to create the money in the economy in return for making taxes only payable in the money that they create. And that actually provides an incredible control mechanism for the social and political life of any country. The best definition of what the monetary system is that I've found is actually by a guy called Martin Schubig. And his he worked a lot in the field of game theory and institutional finance and etc. Institutional economics. I mean, I could find that and just read it, but I'm not going to. I'll put a link in the description. So just to recap, okay, money is debt. Money is created by banks when they make loans to people, including mortgage loans. Mortgage loans make up a substantial part of bank balance sheets. Bank balance sheets and central bank balance sheets massively increased over the course of the pandemic. In 2019, in September 2019, there was a spike in what they call the repo rate. That's the overnight rate of interest banks charge to each other. So we're going to move on to swaps in a minute. And what that actually meant was that if you look at the housing market, the London market peaked in about 2017, between 2014 and 2017. From 2009 to about 2012, it started recovering modestly, okay, and then it started picking up steadily. As I say, London peaked and the prime market peaked in about 2017. Then by 2019, things started to head south. Then the pandemic came. There was a big dip. During that dip, the price of oil went negative. But then there was a huge surge in prices and a massive bubble was blown up. Aided at the beginning, it was given a shove in the back by the government doing the stamp duty holiday. Now, this is something else which doesn't seem to get mentioned. Now, people are talking about, oh, the government needs to give help to mortgage holders or whatever. The government has given two shoves in the back of property prices. One is buy-to-let, but the other one is actually stamp duty. And stamp duty is a huge tax, and it distorts the market, frankly. Now, the other thing about all this money stuff that people really need to know is that governments do not charge taxation to fund their spending. Okay, that's done through the gilts market, and the central bank provides the treasury with the money it needs. And when a government taxes, the money that's collected in taxes is destroyed. Okay, now what that actually means is that a loan is on one side of the balance sheet and the debt is on the other. So someone gets the money and there's a debt, and those two things balance. Okay, now it's called sectoral balances, and David Graeber did an excellent video about that on The Guardian a few years back. Sectoral balances, David Graeber, what your government doesn't want you to know about money and debt. Okay, that's the late great David Graeber. Now, so the point that I really want to make is this. Okay, at a superficial level, the shell game going on here is not evident. Most people are ignorant, will remain ignorant of this, and have been for many, many a long year. In fact, during the American Revolutionary War in the late 1700s, Benjamin Franklin and Jefferson, both very good on money. In fact, politicians in that era and approaching the fin de siècle, which is the late 1800s. So the 1890s was a big explosion in monetary knowledge, shared knowledge. A guy called Alexander Del Mar wrote a book called The Science of Money at that time. You can still get it. You still read that on the Wayback on the Internet Archive. The guy called Stephen Zarlenga wrote a book called The Lost Science of Money. Stephen's left us now as well, unfortunately. He's passed away. But Lost Science of Money is a brilliant book. And Bernard Lietaer that appeared on the video at the beginning of this thing. So, right, residential property is a massive part of bank balance sheets. Okay, I did a blog where I worked out what those percentages were, but it's over 50%, and depending what measure you take, it's as high as 78%. Okay, now when you take that point into account, the idea of a home being somewhere to live, that's the way, that's the best way to look at your home. It's somewhere to live, but it's also a thing you can save into, and it gives you options later in life, and actually with the ability to move around. People will sort of say, well, if you rent, that's the convenience of moving around. Well, until the rental market is sorted out, and with the targeting of buy-to-let landlords, the landlords who are called for-profit social landlords, who are stood in the wings ready to pick up the pieces. I did a blog called The Uberization of the Property Market, and it's an Uberized model, and you'll pay through your nose, because those people are what's called rent seekers, and rent seekers in predatory capitalism, rent seekers and industrial capitalism are not easy bedfellows. So rent seeking is kind of a Marxist term, and so it's not that popular, but it kind of individual landlords here and there trying to make up a pension thing, so make some sort of provision for their old age. They're not the ones you should be pointing the finger at. It's the mega combines, and so some housing associations are great, others not so much. But these for-profit private landlords it's a contradiction in terms, and they are rent seeking. And what they're trying to do is find somewhere to place all of this money that they've created for themselves out of nothing, and they're trying to, with that nothing, get the something that other people have actually exchanged skin in the money game for. So that's what's going on here. Okay, so the people that really need to look out are the buy-to-let landlords, and the smaller ones, because you're going to get robbed blind. Okay, and that's been on the cards for quite a long time. Other householders at the margins are going to be held, to ransom. People who have bought in the last few years, depending where you bought and all the rest of it, sit tight and ride it out, because frankly, the more people actually understand the shell game behind this, the less degrees of freedom there are for the people who exploit this system for their own benefit, and that's mainly power. It's not just money. Lots of politicians actually do it for the money rather than the power. I call them politicians with champagne tastes and lemonade pockets. There are far too many of them in the modern political system, and so they're easy to bribe. And the degree of corruption, I was commenting to someone the other day about this. I've never known such a corrupt environment. I mean, I worked in the Docklands in the late 80s and the 90s, and there was plenty of corruption, open sort of secrets about stuff that went on, as it were. But across the board now, the level of institutional corruption is absolutely immense, but also corporate corruption. In fact, the whole model itself, I think, has descended into utter I don't know what the word is, really. I mean, it's just it's a wicked mess of corruption. It really is, and we just got to call it out for what it is. But to do that, understanding how the system is designed, how we're told it works. If it worked how we were told it would work, and that would be great. But the reason it doesn't work is because it's not supposed to work. It's a story, as Wittgenstein's called it. It's an explanation that's a sham corbel that supports nothing. It's an explanation just because someone wants an explanation, and these are the sorts of explanations that get trotted out by promoted talking heads on social media, and obviously in the mainstream media. Social media is mainstream media. Who knew? Anything that comes up in a news feed or a Twitter feed or anything like that, anything that's promoted, effectively that's mainstream media. And that doesn't appear there by accident, and it certainly doesn't appear there through your own choice. Your choices are sorted, analysed, and then the acceptable narrative to put you into one pole or the other to get you into a binary debate and arguing with other people about stuff you absolutely probably don't know very much about, but you probably think you do. So I've dubbed Charlie Lambdin Housing Greta, moving house with Greta. Our house is on fire. You know, how dare you? How dare you? It really is. You know, the depth of this big trick that's being pulled, and it is a confidence trick. I mean, banking is all about confidence. You can add trick on the end, whether you want to or not. Some people sort of say, oh, it's a Ponzi scheme, it's a this, it's a that. It's all of these things, okay? But the point is, a good, sound monetary system, a good banking system, honest money and honest bankers really, really can help an economy. But that's not what we've got at the moment. There are still plenty of people there that hold to ethical ideals and do hold some of the old ideals of the City of London, for instance, to, you know, hold them quite dear. It's just that there are far too many that have been promoted up the greasy pole that don't hold them dear. And they're promoted by people that actually want to bring the whole thing down. And it is broke. And therefore, it's broke in terms of being broken, and broke as in terms of being insolvent. But what we need to do is actually know what the latest stunt is, and to examine this current stunt, it would help people to read Andy Veritore's new book about the libel rigging scandal. But there are lots of scandals to do with insider trading, fines on banks for all sorts of nefarious activity. But the nefarious activity that went on with the looting after the 2008 financial crisis is not limited just to the famous case of the Reading branch of the Special Business Group. You want to know about all that stuff? Steve Middleton and Paul Carlier, if you look at their work, and they've represented quite a lot of people. There are quite a lot of cases in the pipeline. One very large one, which a friend of mine has got going through, both a criminal investigation and a civil prosecution, is going on against some of these nefarious activities that went on back then. And some of these cases, most of them are a few £100,000 here and there. The case I was just talking about actually involves several £100 million. It's a friend of mine. And a lot of these things are clear. Obviously, they're not in the newspapers, right? And there's no point even trying to get them in the newspapers. That's not what newspapers are for. Newspapers are there to cover this stuff up, not to find it out. Libel's probably sufficiently distant now that Verity won't get himself into too much hassle for writing what essentially is old news about libel. So anyway, just a quick note. I'm going to go back to that note I was just going through. Where are we? Let's have a look. So this worries me, this curve here. This is in the Euro area, but it's the same in Britain. The so-called Trussonomics kamikaze budget. Okay, I'll say now, whether Liz Truss was right for the right reasons is doubtful, but she was right, and so was Kwasi Kwarteng. That they wanted the British economy to be doing better and maximize the possibilities of operating outside of the European Union cartel. Simple as that. And where we're at now is quite bad in terms of the interest rates which the banks are trying to swindle us all out of, and it is a swindle. So the Fed hikes, okay, you need to watch a John Titus video. I've got a blog called at the Stage of Eating Its Own Tail, and John Titus showed the vulnerabilities in the American banking system just in the run up to Silicon Valley Bank going broke. Now, what caused that? Well, what caused that was the increasing interest rates devalued the securities held in the balance sheet of those banks. Those securities, if they are going to be held to maturity, okay, aren't a problem. But if you have to do something called mark them to market or mark them as for sale, then the current price of them becomes relevant, because it becomes part of your short-term liquidity for paying depositors. Now, as we've seen, when a bank makes a loan, that creates a deposit. Now, when interest rates started going up, the value of the securities, so these are gilts, bonds, various commercial paper or whatever, if interest rates are going up, then the value of those pieces of paper go down. And if you've got cash depositors, so if the bank has liabilities to customers that have deposited cash with them, then, or if they want to loan money out, their ability to service that is greatly impaired if the value of their tier 1 capital goes down. So the rise in interest rates caused a number of banks to get into trouble. Now, actually, there's a piece of John Titus's work here open here. So notable bank lists, large and or fail. So these are all US banks, and it talks about net loans, deposits, total equity capital. Okay, so so this is John Titus's web spreadsheet of different banks and their various equity capital as a percentage of outstanding loans. This one here, Silvergate, was at 5.04%. USAA Federal Savings 2.71%. Blimey. Bank of New York Mellon 8.24. See what the lowest one is, 7.62. Morgan Stanley Private, blimey, that's quite low. Goldman Sachs is blank. Regions Bank, UBS, JP Morgan Chase, HSBC, so they're all just under 10%, but some of them are much lower than that. Large and or failed. Anyway, look at John Titus's work, and that's what happened anyway to those. But at the same time, you see, pension funds and insurance companies have to hold. They need to generate income to pay out existing pensioners, and then people save into their pension pots, etc., and that whole thing. So people talk about underfunded pensions and things like this. Now, that in the Eurozone really worries me, that deposits from pension funds, it may well be that they're putting the money elsewhere, but there's a guy called Kyle Bass, and a famous quote from him back in the financial crisis was that investors are being forced further and further out on the branch of risk to get any sort of return. And you see, this is the thing, interest rates going up leave too much of the pie in the pot for the banks, not enough in the real economy, and not enough of the lending they do is actually done to the real economy anyway. There are two circuits, and the financialized casino circuit hogs most of all of this, which is why you see things like the stock market going up. And fundamentally, fewer and fewer people have access to this massively inflated money, and the people that do have access to it have got first dibs and rich pickings on successive waves of people who get looted. And as I say, buy-to-let landlords are definitely in the frame for looting this time round. Last time round, it was small to medium enterprises and smaller business people, their homes and stuff like that. Just to say, Andrew Bailey was in the thick of all of that with the FCA, etc. I'm surprised he's still in a job, except I'm not, because we've also got a corrupt chancellor, Jeremy Hunt. It's an absolute shit show. British politics. I think Rachel Reeves is just as dumb as Hunt. They all subscribe to a view that looting's fine as long as we're looting the little people. Starmer's married to a billionaire's daughter. Sunak's married to a billionaire's daughter. As George Carlin said, it's a great big club and we ain't in it.